Hey, Sue here. This is one of those fitness moments, but hey, I don't talk about fitness because I don't know enough about that, but I do know about fitness and finance. How's that, right? So this would be a fitness and finance moments for you. I had somebody on my YouTube channel ask me about beacon score and credit score, how it matters in regards to financing. Short story is the higher the better, right? 680, 720, whatever, depends on different lenders. So a short answer is higher the better. Very low scores won't get you anything. High scores may even get you a better rate than most places. But it also depends on what hat you're wearing, right? Here's what I mean. If you're wearing a consumer's hat, buying a nice residential house like this, right? Credit score is very important. However, when you're doing commercial financing and construction, for example, which is another house down the block here, it doesn't matter as much because, for one thing, finance on that side is typically looking at overall risk factor, right? More than just the personal credit risk. Because sometimes there are many partners involved and a corporation involved. If that company is in good standing, it's great. If it's got bad name in the press or on Google for that matter, not good. It's worse than having a bad credit, personal credit. So, example, if you finance a construction on a house like that, credit score won't mean a lot. The difference between 600 to 700, 800 doesn't mean squat, right? To commercial lender. What they want to see is the history, the experience, right? And the track record. If they're good at what they do, and if the company is successful enough in the long run, right? And the financial statement. If the financial statement has a big, strong balance sheet, good retained earnings over the years, good cash flow, good profit margin, then that's terrific. Now, I know you're probably a personal side, so you're probably asking, how about, so I just want a regular house, condo. How does it matter? I mean, after a decade in the banking world myself, and also another 10 years actually in the residential side. Plus today I do a lot of commercial, but so that's why I'm giving you a commercial standpoint as well, not just the residential side, right? On the residential side, credit score matters a lot more than it used to be, right? At one time you can get a low beacon score, a FICO score of 580, and you'll be okay. Now today they want 640, 680, right? To qualify, and there's a couple reasons being. One, the rating system has changed, and the new Equifax systems is rating is quite different than it used to be. I just want to put it that way, right? The way that they score credit in the past has something to do with overall long-term history, right, rather than something recent. But the new rating scale has flip-flopped that, so that any recent increases in credits, in like balance, for example, matters more than if you never miss a payment for 5 years, right? In the past, that was the opposite. Any recent changes wasn't effective as much, or wasn't weighted as much, so that means it didn't push the credit score down quickly. But if you had something racked up recently from renovations, all your credit cards used up, all of a sudden your 800 credit score beacon has dropped down to like way low, 600, right? How does that happen? Because the way that they weight the characteristics of your credit, right? Not just the history, but the outstanding balance and recent increases and recent transactions is more, I guess in the way they say it's more susceptible to bankruptcy. If somebody's just racked up all the credit card all at once in the last 30 days. Whereas, if you did it years ago, it wouldn't matter, right? If you never carry a balance over time, but then all of a sudden you did it recently because it's an emergency, it won't reflect on you as much in the past credit score rating system. But in today's scoring, it sucks because now they're unfairly punishing people who have used up the credits, use up their lending limit in such a short period of time. It triggers it so that they think that you're susceptible to be a bankrupt candidate. Sure, I get it, right? But that's the way it is. And I'm not saying it's the right thing or the wrong thing. I'm just the one who's telling you about it, right? But besides that, anyway, so having a high beacon score, 680 or 800 or 900, by the way, is like holy grail. You rarely ever hear that, more often in the past than it is in the recent years, right? So if you have 680, 720, 780, it doesn't really matter. It will give you the same mortgages as somebody with the lower end, as long as there's a minimum threshold you hit, right? And there's always exceptions to the rule too. So if there's a real exceptional case, such as some recent missed payment because you're overseas and during this pandemic time, for instance, you never missed payment in the past, but now you're carrying a huge balance and you missed that 30-day payment, and that plummets your credit score really hurtful, right? And that's because due to the situation. So as long as you explain to the lender that exactly what happened, then that should be okay. So this is just my 2 cents from a mortgage broker, right? So if you have other pertinent questions, feel free to reach out to me or just comment below, and who knows, I'll answer direct, or I'll create another one of these videos for you and answer your question that way. Take care. See you at the top.